Welcome to our fourth quarter video update for the year 2021. Today, I have with me my fellow portfolio manager on the private wealth team, Maria Dawes, as well as our special guest, Glenn Murray, Chief Investment Officer and President of Capstone Asset Management. Welcome, Glenn, and thank you for joining us today.
Hi, Janet.
Glenn, I'm going to start off with the first question for you. So this March, we'll actually be at the 2-year mark of COVID, which is frankly disappointing and somewhat frustrating. With the heightened transmissibility of the latest COVID variant leading to more lockdowns across the country yet again, it's hard not to feel like we're moving backwards instead of forwards. My question is, what kind of an impact is this having to businesses? And the second part to that is, how will this affect our future, given struggling businesses and our government's increasing debt load amidst the latest aid and relief programs?
Thanks, Janet. Nice two-part question to kick things off, I see. So let's start with impact to business, which I believe has varied greatly based on kind of the industry, the location in Canada, as well as the business health entering into the pandemic. The government's support of business has also had varying levels of impact depending on different factors relative to the particular business. But in a lot of cases, the ones really needing support wasn't sufficient, particularly in those areas of the country where severe, long-lasting restrictions existed. There is a business barometer published by the Canadian Federation for Independent Business, or CFIB, that measures small business confidence in Canada, where the recent January report paints a more discouraging picture, as it indicates that small business owners' optimism is at a similar level to late spring 2020. With a measure on the index of over 50 seeing growth, January's preliminary numbers show a decrease from December of 10.5% on the short-term outlook, with the index at 34.5. And that represents the next 3 months outlook. The 12-month index is better at 52.4, which is a slight growth expectation, but that is still a 9.8% decrease from last month. This shows that optimism for growth is weak for small business and could have an impact on things such as hiring, wage increases, and economic growth over the coming year. Although recent moves towards reopening will help, my expectation is that businesses will be a little bit more cautious in this renewed round of reopening. However, broadly speaking, the economy has recovered well into the fourth quarter, which would indicate many businesses have fared well overall, and the labor market definitely has recovered strongly. I'd also say that the pandemic and the government responses to it are having two key impacts. Firstly, they are contributing to the inflationary pressures currently being experienced. And secondly, I continue to believe that the size of the debt load on Western economies will be an ongoing drag to economic growth in the long term. With respect to inflation, I believe the pandemic and the government responses have contributed to both demand and supply distortions, which are key factors to the inflationary pressures being experienced. On the supply side of that, the bottlenecks seen in the supply chain are certainly enhanced by additional factors like weather, but the pandemic and global government decisions have been factors in the situation we have experienced throughout 2021. These disruptions are likely to continue as they take time to work themselves out, but with continued government intervention for COVID-related arguments, this likely prolongs the issue and increases uncertainty in 2022. On the demand side, we have seen elevated demand driven by government interventions that adjusted consumer spending. This was primarily through access to increased liquidity, as well as focused demand due to restricted options. These demand distortions shifted spending significantly towards durable goods and away from services. Services have now mostly normalized, other than where recent parts of the country experienced significant COVID lockdowns, but the distortion in durable goods remains high and a contributing factor to inflationary pressures. These are likely to diminish as economies open, as the fiscal stimulus packages are eliminated, as well as then due to the longer life cycle that we see of durable goods. The reduction of these demand distortions will likely have a positive impact on inflation due to an easing on supply chains, but could result in a reduction also in consumption in 2022. Although I would expect that to drag out to later in the year, it could negatively impact GDP growth. With respect to the debt load, Western governments entered the pandemic with significant debt overhang on their economies. Rather than taking advantage of pre-pandemic years to get debt under control, the governments continued to spend excessively and arguably unwisely. The challenge with debt loads at the level they currently are in Canada, US, and other economies is that it is a headwind to economic growth as it limits ability for countries to spend on necessary areas. Think Canadian healthcare as an example, and it restricts flexibility in the face of crisis or recessions. In addition, it has a detrimental effect on the effectiveness of the debt's intended impact on the economy. So once a country has over a certain amount of debt, which many Western countries are already at, there are some studies that demonstrate that this can cut future growth by half. It is clear that both the Canadian Central Bank and the US Fed will begin a cycle of increasing interest rates to address the inflationary pressures. Although I currently expect economic growth in 2022, I do have concerns that aggressive raising of rates in an attempt to fight inflation could negatively impact the recovery, particularly if the inflation we have today is closely tied to the distortions in demand and supply caused by the pandemic and subsequent interventions. However, we do need to be mindful of inflation expectations becoming embedded in people's thinking. However, navigating through this pandemic has been anything but predictable, so I don't expect it to start now.
Thanks, Glenn. I know we've spoken about this before, but going back to inflation, I've heard the argument that inflation must be transitory when looking at global treasury notes, for example, the implication being that rates are still at record lows, which is indicative of inflation not being a long-term concern. So what are your comments, if you have any, or any argument to shed more light around whether inflation is transitory or here to stay? Because my grocery bill is definitely still going up.
Yeah, I suggest treasury transitory appears to be a word that is too loosely defined to be of meaningful value when we discuss inflation. I believe it's important when discussing inflation to try and understand what contributes to the headline number and what are the factors to those areas of inflation. At this time, I think it's fair to say that we are having to deal with inflation, but that it is currently experienced in primarily a few specific areas of life, one of which is definitely your grocery bill. Without reading or hearing the specifics of the argument you mentioned in the question about the transitory nature of inflation, I would suggest that the argument may be referencing the 10-year break-even inflation rate and or maybe the five-year forward inflation expectation. Now, the 10-year break-even inflation rate is a reliable indicator of the market's expectations for future inflation. Like all rates, they can be impacted by short-term factors, but it has proven to be reasonably reliable. This is basically a measure of the inflation rate over the next 10 years that would make the 10-year treasury equal to the 10-year inflation protected security or TIPS. Currently, this indicator peaked in mid-November and has come off in the region of 14%, while over the same period, the 10-year treasury bond is up 10%. In addition, the five-year forward inflation expectation is another measure used to gauge the market outlook on inflation. This measures the difference between the 5-year rate and the expected rate starting 5 years from now. This peaked in mid-October and is down approximately 16% since then, while the 5-year treasury is up approximately 35%. With both these measures, the market is indicating that the outlook for inflation is not a long-term issue, with the 10-year break-even expectation at approximately 2.4% and the 5-year expectation around 2%. So as discussed at a macro level in the previous question, I see the pandemic and government intervention as contributing factors to the main areas that we see significant inflationary pressures. Those pressures are coming from sectors like energy, food, transportation, and these distortions will take time to work themselves out as pandemic restrictions and interventions are eliminated. Central banks will attempt to influence inflation through monetary policy, where its effectiveness will likely be tied to how its impact or how it impacts the roots of those distortions. In this case, maybe inflation will be as transitory as the pandemic interventions and distortions prove to be.
Glenn, can we talk a bit about traditional markets? They performed quite strongly in 2021. And I know that when Warren Buffett has been asked to make predictions about the market's future, his response is, I have no idea what the stock market's going to do tomorrow or next week or next month or next year. Do you care to make any predictions or general comments on where we are at in the traditional markets? And if not, what would you say to someone that is asking how we expect our traditional equity fund to perform in 2022?
Well, Janet, I'd have to say that I clearly fall within the Warren Buffett camp of avoiding crystal ball prognostication on markets. I learned early in my career that forecasting in this nature is a bit of a fool's game, so I'll avoid that. However, there are things we can say about the market, particularly as it got off to a rough start in 2022. I expect traditional markets to face pressure or headwinds this coming year. The tapering of monetary policy intervention and expectation of central banks increasing interest rates will remove liquidity from the economy and could make stocks less attractive, particularly higher multiple ones. Potential risk of slowing earnings from corporations with the removal of government support and the pressure of these increasing interest rates could limit or lower multiples being applied to company valuations. And of course, we can't yet remove the ongoing pandemic uncertainty and the implications of this, particularly here in Canada, where studies have shown we tend to be on the severe end of lockdowns, restrictions, and mandates compared to much of the developed world. A combination of limiting supports, increasing interest rates, and limiting liquidity could all contribute to market pressure. Finally, the geopolitical uncertainty surrounding the Ukraine situation should not be ignored as a potential contributor to market volatility. So I guess I see a number of areas of negative uncertainty in the market and anticipate that markets could be volatile in 2022. However, we can typically find areas of uncertainty every year, and therefore we choose to avoid equity markets at our own risk. So what we do know for sure is that trying to time the market is not a good investment strategy, and that we should remain exposed at a level commensurate with our risk tolerance. Additionally, ensuring a balance in our portfolio between both traditional and non-traditional equity investments will lower the volatility and smooth out return profiles of portfolios. For this reason, it's probably more important to ensure that with the headwinds that the market may encounter, that you are properly allocated based on long-term risk rather than expected returns for 2022.
Thanks, Glenn. I'd like to talk about something a little different, and that is about our target rates of return. We target rates of return for each of our funds, and I'm wondering if you could talk a little bit about how we come up with those rates of return and if they're actually meaningful.
Yeah, that's a good question. I consider them to be very meaningful as they create the platform from which the fund management team at Capstone builds its investment thesis for asset allocation within the fund. So in other words, when we are performing due diligence on investment opportunities, the target rate for the fund forms one of the starting points for the type of risk and performance expectations we have when looking for investments. So as an example, if we're looking to make 8% in a fund, we are unlikely to look at T-bills as a long-term investment. However, we don't view each investment in isolation, rather in conjunction with all the other investments in the fund's portfolio. So we look for a variety of risk and performance profiles within the fund, but with a target rate of return as the objective of the combined investments. It is also our intention that they are meaningful to our clients as well. Clients can look at the fund's target rates of return as a component of their risk assessment of a particular pool and the role that that pool performs within the context of their overall portfolio. With respect to the process of determining these target rates, we consider several factors. To start, liquidity. What are the liquidity requirements of the pool? If a pool is less liquid, then it affords greater flexibility on the inclusion of certain investment types, offering better returns. Then there's the mandate. This dictates the types of investment strategies that can be held. which will naturally place restrictions on the level of return that can be achieved with these investments. We identify the functional role of the pool. So what role will the fund play within a portfolio, and the nature of the risk expectations that come with that role. And finally, the risk expectations of the pool specific. What level of risk is desired or expected within the pool will put a cap on the rate and on the nature of the underlying investments. These factors, along with some others, form the basis for the decisions on target rate of return that we trust are useful for clients in their assessment of our different strategies.
Since our conversation has shifted to the fund level, it'd be great if we can actually talk about the non-traditional equity fund, which has had a very strong year. In fact, I believe its strongest year to date. What contributed to its performance, and what is the outlook for 2022?
Yeah, Jana, that's correct. It did perform well this last year, with our I class ending up over 10% for the calendar year. This fund was launched in the spring of 2014 with an objective of providing investors a way to access non-traditional assets that traditionally had barriers to entry. The pool was to provide low volatility and low correlation to equity markets while providing a reasonably consistent performance. Over the pool's life, it has become increasingly clear which asset classes create the best balance that can achieve these results. And I believe 2021 was the outcome of a rebalancing done early in 2020 towards those asset classes. So today, the fund's main asset classes are real estate, private equity, and infrastructure. Last year, we saw strong performance coming from the private equity space, as well as some good performance contributions from portions of the real estate portfolio. As the pool enters 2022, it is in a good cash position to make opportunistic investments and fund several exciting opportunities in the pipeline that should contribute positively to the performance throughout the year. Although I don't make performance projections, we continue to target returns in the 7 to 8% range each year, and 2022 is no different. However, like all investments, the fund is not immune to economic issues, but we are able to target opportunistic investments to manage these risks and provide portfolios with some natural hedges against issues like inflation. Additionally, with its correlation to the traditional equity market and low volatility, it performs a strong diversification role in all portfolios. And with the potential uncertainty facing markets this year, it is positioned to hedge a portion of that uncertainty.
Since we're at the start of a new year, it'd be great to hear of any exciting news. Do we have the launch of any funds planned for this year? And if so, can you talk about them?
Sure, we definitely do have plans. In fact, we're looking to launch a couple of structures that are different from our historical offerings, and will offer clients the opportunity to customize their portfolios further towards their interests or return needs. We've discussed previously on calls about the core and satellite pool roles in the customization of client portfolios. The new opportunities are really focused on the satellite part of the portfolio to provide greater customization. So the first one I'll briefly discuss leverages off the investments that we are making in the non-traditional equity pool. We're launching a structure that would allow clients to co-invest directly into a residential development project in Nevada with one of our partners we have worked with on other development deals. This offering will allow clients to increase the risk and return profile of their portfolios by investing in a project that we are structuring to target an approximate 12% return. The structure and the return profile is still being finalized, but it will be a small offering with a limited life that is connected to a specific development project and will allow clients to increase their target return in their portfolio. Going forward, the objective is to provide these co-investment opportunities for clients as an ongoing complement to their core investments in our other pools. The second offering we are looking to launch early in 2022 will be our first impact fund. This will be the first opportunity for our clients to invest in a pool that is specifically designed for the purpose of impacting the community we engage with while generating an investment return. In short, the strategy will be an agricultural impact fund with the objective of training local entrepreneurs to farm the land and for them to ultimately own and operate the farm. There will be a lot more details coming as we finish putting together the model and opportunity, so this is just a very brief teaser. As you can likely tell, these strategies will be structured differently to our normal open-ended funds and will provide clients with a greater customization opportunity in their own portfolio.
That sounds exciting. Thank you, Glenn, for joining us today amidst what I know is a very busy time for you. It's always an enjoyable and insightful time for us as well.